As market expectations on rate cuts have moved to September for many of the banks, at least several of the big banks pushing out their previous June rate cut expectations to later on this year. One company, though, that's on your screen right now that hasn't is Citi, still expecting a June cut. So let's talk about that with Robert Sockin. He is Citi's senior global economist here to break it all down. Robert, it's great to have you here. So talk to us just about, walk us through your expectation and why you think June is still in play for the Fed to cut rates.
Hello, thanks so much for having me. Yeah, it's a very close call about when the Fed might start cutting rates. I think this is still a Fed that would like to get the easing process started at some point this year. But, the inflation data for the first quarter has come in a lot stronger than expected. And at the same time, the activity data has come in more robust than expected as well. So that combination of factors, I think, is leading to exactly what you said, people to push out their calls for rate cuts as well as markets to push out as well. We still think there's going to be enough progress in inflation by the time you get to that June meeting that there'll be enough evidence that the Fed is willing to start that easing cycle. Now, after that, it could be a very gradual easing cycle depending on how inflation and the economy hold up. But on balance, we're holding to that because I think there's going to be enough evidence that they could get that started. But as I said, of course, the risks are shifting to a later start and to a slower grind down of the policy rate.
Is that because we were stuck on transitory for so long, or is there something else that is now at play, Robert?
I think it's with the inflation element. We're still seeing very sticky services inflation that looked like it was coming down pretty significantly as goods inflation was also falling, but it's kind of stalled out, not just in the US, but also globally. We're still seeing in a lot of economies kind of extensive services pressure. So I do think that you're seeing central bankers in general being cautious because they're worried that that services side of the inflation might be longer lived than they had originally thought. And as I said, at the same time, if you look at the US, the economy is particularly resilient. So the Fed may be in no rush to cut if it's worried about inflation being stickier for longer.
Robert, if we don't see a cut in June or July, would that be a mistake?
I think it again depends on the outlook. The economy has been surprising us significantly to the upside. We just saw very strong numbers come out of the IMF for what it expects the U.S. To grow. So I think if you're in an environment where the economy is growing that well and inflation is coming down slowly, then it makes sense for the Fed to potentially show some patience. Now, there are some signs that some things are softening in the U.S. We're seeing some labor survey data look a bit softer, seeing some strains on lower income consumers. So, it's going to depend on how the outlook evolves. But I think if the data continue the way that they are, I think the Fed can be patient. So it all depends if the data in the second quarter looks like it's looked in the first quarter.
Nobody likes to hear that wages might need to moderate even lower or be in decline, but is that the reality of where we'd finally see inflation really get towards that Fed target?
I think that's the huge debate right now. Right now, we're seeing wage growth being well above pre-pandemic levels in a wide range of economies. And the question is, can services inflation, which is much more labor intensive than goods sectors, can services inflation come down with wage growth at these levels? It's possible. You can make arguments that could be more sustainable. For example, in the US, we're seeing much stronger productivity numbers of late. Now, it's unclear if that's a productivity surge or if it's just making up for weaker productivity earlier in the pandemic. But if you are actually getting a big productivity boost, that would mean that those higher level of wage growth that we're seeing could be sustainable. So there's a lot of factors. So it doesn't necessarily mean that if wage growth runs at these levels, that services inflation can't come down, but you need other things to be happening in the background to make those level of the wage growth sustainable.
Robert, are you confident that we are going to see a soft landing scenario? Because we've been talking more and more just about how a no landing scenario obviously getting a bit more play. How confident are you that soft landing is still likely and in the cards?
Yeah, I think certainly if you look at the back half of last year, the data were really feeling quite soft landing-ish. You were having on that 6-month period inflation running pretty close to target, and you were seeing growth remain quite resilient. Now, as I said, with that stronger inflation data to start the year and resilient activity, you do raise the risk that it could be a longer drip down for inflation to come back to target. But I would still say, that the data are kind of feeling soft landing-ish in this environment, given the still strength that we're seeing on the consumer side, and the fact that inflation has improved in a lot of dimensions. It's still obviously too high, but it's much better than it was earlier in this cycle. And it might just be that it's going to take longer for it to come down, and that's where the Fed might be thinking that they can be more patient bringing down rates. But I think certainly over the Q1 period, that soft landing probability has risen quite a bit in the U.S.
Yeah, New York Fed President John Williams speaking today, and we were flashing across the bottom of the screen just a pull quote of what he had said, and not seeing urgency to cut rates right now. To your point, Robert. Thanks so much. We got a host of Fed Speak coming out later on today as well. Robert Sockin, Citi, senior global economist, joining us here today. Appreciate it.